Well, hello and welcome to everybody to our signal versus noise navigating the resin market disruptions live info session. You might notice that we're in a bit of a different location than some of these that we've done from primarily our home offices. We have the whole team together here in Fort Worth, Texas, where RTI is headquartered. And we're in this beautiful podcast studio. With me, I have Greg Eberhardt and Kevin McCaru uh, here to talk about signal versus noise today in this really cool studio. So, welcome to everybody on the call. We're going to kind of work through this together as in a new format. So, let's do maybe just a quick introduction. Kevin is the senior consultant for polyethylene, and Greg is the senior consultant for polypropylene here at the company. I myself am the senior consultant for engineered resins. So between the three of us, we're going to talk about something that we talk about all the time, which is how we can help resin buyers understand how to distinguish meaningful market signals from noise, what actions separate strong procurement teams from reactive ones, how to adjust strategy during volatile market conditions, and how fundamentals, not the headlines, is what drives decision makings for strong procurement teams. So this info session should feel like an insider guidance from us, and that's what we're here to ultimately talk about, and maybe to frame that problem a little bit. In today's marketplace, buyers are overwhelmed with information. We have news headlines with what's happening in Iran today. We have supplier messaging that's coming out early, often. We have market indexes that are trying to keep up with this incredibly volatile market that we're experiencing right now, with the Strait of Hormuz being closed, and this kind of black swan event that we're navigating. And then there's internal pressure on forecasts and what's happening. Are we going to run out of material? Do we have to change our mindset to be more supply risk rather than pricing? And the challenge isn't really a lack of information. The challenge is sifting through to understand, is this a true fundamental signal and it needs to be considered to drive an action, or is this noise and a distraction? So before we get all the way into the discussion here, I just want to ensure that if you stick around with us to the end, we are offering a live, every attendee to this call will have access to a free resin benchmark process that's built specifically for your company and the materials that you buy. So it's your resin, your plant, your SKU, and your fair market price. So if you stick with us to the end, we will be offering that, as well as some Q&A. So with that, Greg, from your perspective, what separates the teams that protect margin during disruption from ones that end up explaining margin losses after the fact?
Great question, Tyler. If I look at the past couple of years, there's been several types of disruptions. They've taken many forms. There have been geopolitical instability events, very similar to the one we're working with right now with the Middle East conflict over in Iran. We've had COVID supply disruptions. We've had Winter Storm Uri, and we've had a number of unplanned feedstock disruptions, as well as some consolidations and mergers and acquisitions. So what can you do? I think it's first to make sure that you're able to prepare and do the best you can in terms of upfront, not knowing the what, but how you're going to react to the how. So in terms of prior to a significant disruption, being prepared, having a strong risk management program in place that aligns with your stakeholders, and knowing where you're exposed. Once an event occurs, very critical to mobilize quickly with your key stakeholders, kind of understand the situation, be able to manage that message with the stakeholders, have full alignment, and make sure that you're ultimately managing that message up to the leadership. And I think what we tend to see is most buyers react very similarly during normal times. A lot of buyers, when the disruption happens, some will be emotional and react, and some will react with discipline and structure. And those are the ones that are going to be successful in the long term.
Yeah, it's like I think that resin buyers still have a playbook. Maybe it's tucked away on a shelf from Winter Storm Uri or from COVID, but there's experienced resin buyers who've done this before. They've worn those paths in. They know who to call when they need an inventory count or they need some key piece of information internally to enable either unlocking material that's available out there to use um, or any key piece of their forecast that they may need, right? Like this playbook exists and it's time to dust it off and walk those well-worn paths. So I agree. Kevin, when disruption hits, prices are moving or supplies tightening. What are the most common knee-jerk reactions that you see from buying teams?
So, Tyler, I appreciate that question. And there's a lot of information. I've got my notes here today, and I'm just going to go through for that specific question. Typically, weak supply positions or responses would be I look at the acronym TFDA, right? The first thing is trusting supplier messaging without any type of verification. We see that quite a bit. And then F, follow the headlines instead of the fundamentals. We see a lot of people not looking at fundamentals and they just look at the headlines what they see on TV. D, delay decisions until it's too late. A lot of times that's, an unfortunate part of operations. People just want to delay, thinking it will just kind of go away. And that kind of leads to the last one. A, assume the markets will normalize quickly. Sometimes that doesn't happen. You have to be prepared for all contingencies. So really the goal isn't to predict every type of event, real or disruption. The goal is to be prepared and positioned to respond correctly.
Yeah, it's that playbook that you got to dust off and you got to go back to. And I very much appreciate what you said about don't just trust what the supplier told you on the messaging and take it as fact. When you receive a price increase nomination, that's exactly what it is. It's a nomination. It's a kickoff to a conversation. Now, I think it's safe to say that in the current environment, those conversations might be kind of short today. There may not be a ton of room to negotiate, but simply just hearing from your supplier what's happening and trusting it's poor practice.
Yes, I agree.
So, I mean, with resin buyers that are flooded with too much data, you have what the indexes are reporting, what the supplier is telling you, as we just discussed. You've got the headlines of, Straiter Hormuz close, resin prices skyrocket, fertilizers shortage. I mean, the global economy is really struggling because of this. You have all of that input. How do you know what signals matter and which ones are just noise?
So really the key signals that we look at is feedstock movements. What's happening in the marketplace between the feedstocks for the various commodities? Supply disruptions. Anything we hear about different plant operations and so forth. Export activity, maintenance schedules, that type of thing. And most importantly, inventory levels. The supplier sometimes will say, hey, we're really tight on inventory. Is that really true? A lot of times it's not. So we have to look at all those different areas for signals. A geopolitical headline really isn't a signal. A disruption of feedstock really is. So, core messages basically, not all big news is important. Some of the small signals we see are really they matter a lot to our business.
Yeah, things like political speculation or media-driven panic cycles, supplier narratives that don't have the data that backs them up. Exactly like, hey, we're seeing falling inventory levels, and it's like, well, it's not really true. Or yeah, they declined, but they declined inconsequentially, right? We're still well above any type of inventory level that would justify a price nomination, right?
Yeah, on that note, Tyler, really it's important for our audience to understand the difference between an outlier and a trend, right? Because a lot of times the question is, when does an outlier become a trend? And really skilled procurement experts know that they have to monitor that because there's a lot of outliers out there, but trends happen over time. So they have to really continuously look at that.
Yeah, one other example I would say is that when we look at what's happening in Iran right now, one of the signals that I had noticed somewhat early on was the announcement from Asian producers of that they were not going to take any more orders, right? To me, that is like kind of a moment where you pause and you just kind of sit back and you think, okay, this company is literally turning away money. They're not going to sell. Like what a bold stance to take to tell the market we're not accepting any more orders, right? Well, you can imagine that if that really goes through, and by telling the marketplace it's a strong signal that it will, what's that going to do to global supply trades and and trade flows? So that was an early signal that we picked up, a month ago that said we're about to go into a very winter storm like Uri like environment where we're going to see resins skyrocket. So I think that was a great example of a signal that we saw early um, that could help prepare for where we are today. Um, and speaking of kind of the strategy there, Greg, once you know what signals actually matter, what separates the teams that act on them from the ones that just keep watching the market?
I think that's a great and very timely question, Tyler. I think the first thing you have to look at is once you have an identification that a signal is occurring, you have to understand what change, if anything, is needed. You want to first understand what's the impact to your business, what's the impact to your supply situation, and when do you need to change course or when do you need to stick with the current course that you have. But most importantly is making sure that you're able to tie a signal back to a strategy that you have. If they're dependent, a change is likely needed. If they're not, you just may want to review and understand if you need to change course versus completely change your strategy, maybe just your tactic. I think also it's important to understand what some of the downstream impact is of a signal change to evaluate if that signal is leading you to take action or not. I can use an example recently of we had several buyers with historically low resin prices before the Middle East conflict that weren't buying. There was historically low resin prices. People weren't buying. They didn't want to tie up their working capital. That same resin now, 4 or 5 months later, is significantly higher for the same resin. Are people changing their strategies? Some buyers are and looking to go in and now buy that resin at a higher price. Other buyers are still being a little more cautious and waiting and kind of waiting off. But again, it's tying that signal to your strategy to understand when you need to change and not, and having access to the key data to understand when a signal's occurring or a market's turning. That's what's critical to aid you in your action.
Yeah, I think that's inventory is such a timely lever in your procurement strategy right now. It's so interesting that, kind of during COVID, there was this idea that every company now has a bit of a risk management strategy that's more evolved, right? You've basically um, you went through something, you had some significant disruptions, you qualified alternate sources, you had and that was like a whole initiative across supply chains, for whatever 5 or 6 years or has been. So you qualify lots of alternates, but then that enables you to get money back from your working capital because you just sell off your inventories and you eventually in a stable market, yeah, you get that money back and you can invest it elsewhere. And then when a disruption hits like this and a second black swan and you're not prepared for it, like, well, what happened to those lessons we learned in COVID? We did all those alternates material qualifications. We should have been in a better spot. Well, part of that is just good diligence. And I think that great procurement teams are very comfortable with their inventory levels because they are at what they're at for a reason to weather this storm as well. But along those notes, Kevin, a lot of buyers feel safer when they're sitting on inventory. But how often does inventory actually create risk instead of reducing it?
So some of the recent behaviors before the conflict, there was a pretty calm market out there. So we saw some of our clients in the industry get closer to a just-in-time inventory, lower inventory levels, conserve working capital. The problem is that worked during very stable times. Now we're in a very volatile market, so they're really at risk in a lot of different ways. And so people have to look at kind of the cycle that you're in, and that could really kind of hurt you from having the price escalation risk in the situation. So, also, if you look at inventory, it's a strategic lever. It doesn't have to be operational. You can increase your inventory decisions should be based upon where your demand is headed, supply conditions within the marketplace and demand expectations. All those are very important decisions when you're looking to determine what the levels should be. And then really, if you look at, the fundamentals of rising prices, if you indicate that's probably going to happen and forecast that, it probably wouldn't be a bad time to take on some additional inventory more strategically. And if you see it essentially oversupply likely, you probably want to start reducing. So, the key message is it's just not operational for inventory, it's strategic.
And no buyer avoids every price increase either, right? Like that's just resin buying wouldn't be as nuanced and as difficult a job
Yeah.
as it is if buyers were always winning, right? So right now sellers are certainly making their push to drive that price and margin higher and winning right now. So the idea that buyers are always going to win is an unrealistic expectation. But strong buyers do position themselves to recover faster. So when you talk about one of the tactical moves you can do during disruption, move number one is how do we improve our forecast visibility? So, Greg, how many resin sourcing problems start with poor forecasting visibilities?
Great question, Tyler. I would say probably several, depending on if you have a strong, robust system that's in place. I think most buyers have a pretty good handle on understanding their A items, their risk profile for that, being able to forecast the cost drivers, supply and demand, et cetera. When you start to get down past the A items, though, buyers are pulled in a lot of different directions. There's things taking their time, so maybe they don't work down as far into the B and the C items that are remaining. And those are a lot of the items that you're not as familiar with, and those will tend to creep up on you when situations occur. So how can you best prepare for that? Just making sure you have strong rigor that you're using on your A items that you utilize for the remainder of those items. In a time of disruption, leadership is going to expect answers. So you need to make sure that you're able to present those. In terms of looking at a forecast, some of the key inputs you're going to want to look at providing them is forward-looking insights, market interpretation of what the data means, and also risk exposure, and ultimately what help is needed. What do we have to do to reduce our risk, or how do we get alignment around we're okay with the position that we're at? What do we need to do to change?
And Kevin, how much leverage does a resin buyer really have if they don't have any qualified alternates?
Not much.
Not much.
So the key is to use the disruption as an opportunity, right? Approve substitute materials, qualify alternate suppliers, reduce single source risk dependency. Those are all things that we did during COVID. In general, most of the industry did that. And these are opportunities now as well. So very important to kind of look at that as well. So
And it's also possible where you can qualify an alternate material in maybe one of your resins. And if you do that successfully, I think a lot of companies try not to go down that path. I think they would prefer to just negotiate with incumbents, which I understand for speed and for profitability. That's a great place to start. But eventually, if you can even just qualify a single alternate, you can go back to your supply base with confidence and say, we know how to do this. We just did it. It drove a ton of savings, and now we're going to turn our eye to your business. So let's make sure that we get a fair negotiation at the table.
Okay.
Greg, what separates buyers who constantly outperform the market from those who only get lucky once in a while?
I think Kevin hit on a lot of those points already. I'll make sure I can reiterate them. In terms of disruption periods, it's a good time to look at your supplier diversification. Where am I exposed? How can I get ahead of that? To strengthen and reinforce the sourcing strategies that you had in place that made sense prior to the signal or prior to the disruption, and understand and take stock of, do I need to take action or do I need to stay the course? But making sure that you have a plan that you've aligned with your stakeholders to make sure it can be actionable. And I think one of the key messages is during disruption periods, it's not just defensible, it's when the preparation begins. So it's making sure that you're able to take advantage of when you're in a situation to learn from it, to adjust, and to come out stronger on the other side.
Exactly what companies and strong buyers should be doing in when markets are rising like they are now, right? Now's the time to do the work so that as soon as the markets turn over, you can experience the benefits of a falling prices and actually capture those. But as the title of our live info session would dictate, we want to get back a little bit to signal versus noise. So we look at like a black swan event, which is a true disruption, and then you have these false alarms. Really getting into the nitty gritty of distinguishing between the two. Kevin, how often do market headlines create panic, even when the fundamentals haven't changed? And maybe an example of that.
So let's talk about false alarms first. They always seem significant, the news cycle and everything else, but a lot of times they have minimal impact on the fundamentals. So if you look at it, they're usually headlines without significant supply disruption, short-lived events, geopolitical events, and also market rumors without structural changes. So all those are kind of noise in the system that people get really panicked by. Maybe they buy extra, but that's kind of noise in the system. Black swan events are a little bit different. I mean, they fundamentally alter the markets in different ways. Production shutdowns, feedstock disruptions. Those are just a couple. Inventory levels adjustments, the logistical constraints, export restrictions. Those are all areas of black swan events that we look at as signals and say, hey, look, this is an issue we have to take care of now because those are really relevant to our industry. They're just not noise that's out there.
Yeah, and I think you had a really good example when we were talking about this the other day of noise being, what's an example of noise where like it's just on the fringe of like, do I trust it? Do I not? And I think you had talked about like forecasting for hurricane season. And what was that example again?
It was Hurricane Beryl. So Hurricane Beryl came through Texas there, several years ago, and it was forecast to be very devastating to Texas and it did have an impact. But for the petrochemical industry, it was very minor impact. So the media and you'd hear a lot of news about, oh, the impact of this that's going to cause this. The impact to our industry was very minor.
Hmm.
So you have to really look at the situation and the duration of the event, really. So.
Yeah, so sometimes whether it's a hurricane or maybe a plant fire or um, there's a variety of instances where a CEO might come knocking on your door and say, "Hey, I heard this thing. Is that driving our resin prices, uh, up, for example?" And if you're an inexperienced resin buyer, you might go, "Well, I don't know. Let me call my supplier and find out if my prices are going up, and then I'll get back to my CEO." Well, I think what we want to get across to the teams here is that great resin buyers use some other type of resource to solve this problem and to look directly at the feedstocks and the fundamentals. So if we were walking through, like right now, if we were to look at some of the aromatic chain of resins that are derived from benzene, so ABS or polycarbonate, you look at or nylon, right? You look at those resins and the price increase announcements that are out there right now and they're huge. They're somewhere, for back-to-back months, they're between 15 and 37 cents and the first question that we would ask is, okay, well, this is a very real price nomination. So let's do the signal versus noise. And there's plenty of noise out there of what's happening with the Strait of Hormuz and who's getting oil, but we want to look at the actual signal. So we would pull up ResinSmart.ai and I think we were able to pull that up and share it here. Looks like maybe hey, we do have it. There we go. Look at that. This studio is awesome. So if we were to look at the precursor to some of those engineered resins, we would look at benzene and we would say, okay, well, we know that there's a conversion formula of, maybe about 10 cents a gallon could impact about 1 cent a pound for, polycarbonate, for example. So we say, well, this is 15 cents a pound increase. How much of this is margin being passed on, and how much of this is cost, the real signal, right? And you pull up our spot benzene chart here, and you can see, oh my goodness, like this benzene has gone from, a low coming out of December down in like the $2 and change all the way up to settled in April at 409 or something. I think it traded as high as $5 at one point. Um, so if we were to look at the real signal and the underlying cost model, we'd say, oh yeah, I guess a lot of that uh, cost increase is justified, and not only justified, depending on how long benzene stays this high, might have some sticking power. So and then you might, as I typically would, I would just always assume that my supplier is trying to grab margin all the time, right? But when you do the actual analytics and you look at it, you're like, that 15 cents a pound increase that they had for March really wasn't enough to even cover what happened in benzene. So from a negotiation standpoint, of course you can push back and you could say, I'm not going to take this entire increase for whatever reason. But if you're looking at the signals, it's pretty clear that that's a cost pass through from the supplier. So that's I think a rock solid example of pure signal in the data, whether the strait remains closed or remains open. I can almost guarantee that if you just watched this graph daily, you'd find out when the strait opened
Yeah.
because it would be an event on this chart, right?
I think Tyler, in looking at the data, another thing that's kind of critical to point out too is it is a very volatile market. You see a lot of ebbs and flows in the data of where things are happening. Do you think your supplier is going to come to you when it starts going back down to say, all right, we're done with the up, here you go? It's knowing how to find this data, knowing how to react to it, and making sure that as prices go up and you're as quick as they do, that you're also following the market down.
Yeah, and if you're a polycarbonate buyer right now and you said, "Oh, I actually had a pretty good negotiation in July of 2024 and I'm on a 3-year contract and I negotiated, a price that I thought was pretty good at the time." Well, your supplier's making quite a bit or had made quite a bit of margin from, July 2024 through basically, the start of this year, right? All that area above that chart there is margin that could have been negotiated.
Yeah, I think you're pointing out that markets will always move. It's how do you react to them and make sure that you're aware that they're moving.
Exactly. Exactly. And this is just one tool. There's other opportunities to use data like this in whether it's your internal data at your company that you're using or you're subscribing, to other indexes or however it is that you get your information. But ResinSmart .ai has all of the signals for each one of the major resins that's in the marketplace. So it's a one-stop shop to get some of these true analytics done. So with that, um, we're going to open it up to some Q&A in just a moment. Reminder, if you've stuck with us through this presentation, we are offering the free benchmarking process. So feel free to, Mike will be reaching out with those afterwards, and I think we've got some questions coming in already. Great. So I guess let's just put a bow on the conversation and then we'll go to questions. And that's just to say that markets do move, to Greg's point. Disruptions occur. Strong buyers know how to respond to the signals and how to sift out the noise. And smart procurement isn't about reacting just faster, it's about reacting smarter. So with that, like I said, I got Michael texting me the questions here because the Zoom is a little bit off screen here. Um, Looks like we got one here. Can you give a real example of something that looked like a disruption but ended up being noise? Yeah, I think we covered one of those in Barrel.
Well, let's talk about and keep it to the hurricanes again. Last year was a very active hurricane season. Everybody knows that. Everything stayed on the Atlantic. So everybody heard the noise and said, hey, you know what? There's going to be some premiums that go in to cover potential disruptions. But it's really where it hits and the intensity and the impact on the business, which really matters, So it's just that one example, but other examples might be turnarounds that maybe don't go as planned. Well, if there's a lot of inventory in the system already, maybe that turnaround is not going to disrupt coming out of the winter turnarounds, the spring turnarounds, because there's enough inventory to cover that buffer. So a lot of examples like that.
What about with what's going on in Iran right now? What are some of the top signals that you're focused on?
Tyler, I can take that one. I think primarily I'm still focused for domestic resin production, focusing on the supply, the demand, and the cost drivers. There may be some short-term tactics that need to change, and we may realize over time that there's some longer-term strategies that may need to change, whether that's going to be looking at supplying a little bit closer for your strategy or not. But I think focusing on the fundamentals prior to going into the Middle East conflict, those are the things that you want to try to focus on for the long-term strategies.
Yeah, and as I think about the Iranian or the conflict in Iran, when I look at signals, I think the feedstocks are a really great place to be spending your time, but also it's like I think when the Strait of Hormuz is going to be, when it's announced as open or safe to traverse again, I think we'll see a big dip in benzene or in any variety of, oil futures, whatever it is, right? But I think that's going to be more noise. Like I don't think that's going to be a true signal because I don't think it has the staying power. It's the like that outlier versus the trend, like Kevin, like you were saying, right? So benzene's, trading like crazy. Yeah, the Strait of Hormuz opens and it's going to fall. But what about the LNG facility that got knocked out in the process of this
Yeah.
conflict? What That's going to take years to rebuild. So what is the impact of that? Because that's like a structural, part of this petrochemical industry that's now an asset that's missing. So how long does that drag on, and what does that do for a long term of not just a day trading window of announcements, but of like a full signal that you can translate into your strategy? Let's see. We got any more questions here? We got one more. How does having qualified, okay, how does having qualified alternate materials actually change supplier behavior?
So I'll take that one,
Go ahead.
Greg. Um, y- if you don't have the leverage and negotiation and you're with a legacy supplier for the material that you've always bought because maybe it was too hard to spec in, it takes too much time, maybe it wasn't allocated as a cost center to qualify, you will pay a premium over the years, and that premium will not be captured right away. However, if you spend the time to do the work, that when it comes to the next negotiation, you're prepared to change the behavior. And all of a sudden, you'll find out your margin, your supplier's margin go down, and your ability to take out more per negotiation will incrementally increase because you've initiated a different wrinkle in the negotiations that happen every year or every other year.
I agree with Kevin. I think you've completely changed the position that you had, the amount of levers that you had, both from a cost standpoint, impact, and also from um, a risk management standpoint, where you now have additional options. So putting yourself in a position, again, being proactive, doing the planning, doing the upfront work to qualify those materials to set yourself in a better position to move forward. Maybe not at the exact time,
Hmm.
but at some point in the future.
Yeah, it's a process,
Mhm.
right?
Yep.
We do get a question from Josh, which is what do we do with information about commodities like Brent crude that trades for one price but bought physically at a much higher price? That's a good question. But
Yes.
a little I'm a little stumped on how to answer that. Trades for one price but bought physically at a much higher price. So this is basically just saying what do we do when the indexes aren't reflecting reality? Is that what I think that might be the question?
So I'll take that one to start with that one. Um, we can talk about the indices, right? Supplier nominations, and they are nominations, started out at 10, then went to 15, then it went to 20, then went to 30 for April. Now there's some for 20 for May or so. The problem is they're getting ahead of what they believe is going to happen. So it's speculation and forecasting without fundamental reality. So that's margin enhancement. It doesn't have, and it'll be harder to take that out later on. So when you look at that you're just forecasting something go up. It's speculation. But the commodity has an actual price that it's worth in that marketplace, not based upon speculation, based upon supply and demand.
Mm.
And right now, we haven't even talked about demand in this discussion. Demand relatively is soft. It's not very strong. That's another part of this noise about prices have to go up. Well, if demand's not that strong, why do prices have to go up? So just something to think about.
Yeah, I think maybe another way of looking at that is just first the identification of knowing that is not the true cost of what's being paid. So that can factor in some of your decisions moving forward to understand, okay, this was my thought coming into it. I have to adjust my model of how I'm looking at things. That'll help me to make some better decisions, some more informed decisions on what the true costs are moving forward. Not every situation you're going to know what the price is of something.
Right.
So you may not be looking at exact one-to-one cost drivers online, but you can still look at the supply demand fundamentals and other things that are going to be impacting those markets.
Yeah. And another example of signal versus noise, like I think when Westlake shut down some facilities, some PVC manufacturing facilities domestically, and I think people were saying, oh, well, is that going to drive price up now that there's, less production? And it's like, no, demand's not there. So you can cut the legs out of supply, no problem, as long as the demand is less than the supply.
Yeah.
It's not going to really, until we get balanced, it's not going to make a much of a pricing impact.
Yeah.
So, Josh, that was a bit of a runaround on how to answer that, but hopefully you found some insights there. And feel free to reach out with a follow-up question if you didn't. We're here to help. That's literally what we do. So if you're not confident in what signals you're seeing, that's exactly the problem we built ResinSmart to solve. So Kevin, Greg, myself, we're here to help. Optional next steps is we can run a benchmark price portfolio for your business. You're welcome to sign up for a free trial to explore the ResinSmart.ai that we showed off here today. And like I said, reach out for any way that we can help. So with that, we're going to close the live section and thank you so much for attending.
Thank you.
Thank you.